I got another.
All right, would you check this thing to see if it's live streaming? There's one of my buttons there's not working. It says share. It still lets me start broadcast.
It won't let you share the screen.
Right. Okay. Now, if you go to YouTube and bring it up, I want to see what you got.
I don't see it. It's under March 31st and April 6th.
No. Let's see. I drug it there somewhere this morning.
I don't know.
Oh, it's
Second.
4/4/2/19. I didn't bring it up to the top. Wait a minute. 4/2. Is that it?
Yeah. Didn't put a title on it.
Oh, that's what I did. Okay. Well, I hope they found it. All right. Um, I just want to know if it was coming through. So, okay, now it's showing you. All right, now what is it showing my notebook there?
It's going to keep on showing me unless you because it's not working.
Oh, really?
Yeah. Click on the Google thing. I don't know why it won't work. I want to share the screen.
I don't know, but I've been doing that for a couple of days and I've not called anybody because I thought it would still work. That's all you see right there. Well, now that's what my eye here is seeing. Um, well, if I had solutions up there, though, you're not seeing solutions either. This is all you're going to see, right? And you can hear my voice. My voice coming through. Well, sorry about that, folks. I'll try to get that fixed.
So if you click the camera,
Huh?
the camera on the top left,
All right, let me try that. Which one? Here?
the blue down to down.
Well, here's what I'm supposed to click, Clayton. You see this one? And I'm supposed to hit share your screen.
Right.
All right, I hit it. You see it does nothing. And I have to cancel it.
Try it again and click the screen. Like that picture, yeah, click that. Now, yeah, there you
Is it working?
go. Well,
It's
hasn't come
very
through on
good.
mine
Yeah,
yet.
this came up like it hasn't before. Very good. Yeah.
So
All right.
now it's working.
Now, if I wanted to bring up this,
I'll see it. Not working.
okay, great. Well, at least I've got the problem solved without calling AV, calling computers or what have you. So thanks.
No problem.
Um, but I've been trying to click on share when I should have clicked on the screen. If I take like that, I know one day last week, maybe both, I take cost accounting that way with a lot of solutions. And this morning I take principles that way with quite a few solutions. But nobody told me, nothing else was coming through. Okay, but at least they got me talking and they got the assignments and what have you. Okay, now we can move on. And it does say Clayton too, stop sharing and all that stuff. Now let's see, where did it go?
You can X on that camera man technique on the top right, not the very top right, so the one kind of
Yeah, we're back to resuming Hangout.
You gotta share the screen.
And
But yeah, just click it, and then you can share.
see, that's easier than share, so I didn't know that. Well, I probably would have felt dumb had I had AP to come over to look at that. Computers. Okay, we have finished up personal, last chapter of 37, those form 4797. And then we skipped chapter 1 on corporations. And now in that last chapter, Clayton, or it might have been chapter 2 of corporations, I don't remember which, but I asked the students to send me a copy of all the even problem solutions. Now, Terry and Hillary has done that. So I need the rest of you to send me copies of the solutions. It might have been that last chapter we covered, 13. Send me the even solutions. All right. And then we skipped chapter 1, courts. Now now give me the even problems on chapter 13. We skipped tax research, chapter 1. Then we went to chapter 2, some of the advantages and disadvantages of corporations, and some of the legal requirements. And that's section 351. Now we're going to look at some of the even problems on corporations, chapter 2 on Thursday. So please be doing some even problem, chapter 2, corporations for Thursday. We're going to get back to that chapter. Now, the other day, if you weren't here and didn't watch the video, and I had a 1040 form up there, 1120. But now, I feel like you didn't even see it. So if I had a form of Clayton, if I'd have went to internet, and I went up here to I want to see the form 1120. Now, if I didn't share that screen, nobody saw that the other day, right?
Yeah, the only thing on the other day, it was on the camera.
That was it. Okay, what I wanted to show you the other day then on this form, I want you to print off a couple. So I'll review it again. Line 1 is just gross income minus returns and allowances. Then you got cost of goods sold, which we looked at that the other day. Goes down to line 3, gross profit, just like an income statement. Dividends we've got to look at. Then there's interest and rents and royalties and capital gains. And there's that 4797 gain. And there's your total income, line 11, income statement. Now your expenses, compensation of officers, salaries, repairs, bad debts, depletion, advertising. All right, those are expenses on the income statement. So a corporation is not hard if you follow the instructions. All right, now here we have learned about depletion, how to calculate and depreciation. Now we're going to have to watch out for charitable contributions here, and this thing won't let me write nothing on the screen today. Nothing. All right. But go on down to line 29 or 28, and you've got total income. And then you've got net operating loss carryover and so on. You've got total deductions on line 27, that is. 28 is taxable income. Now, line 30 is taxable income and do the taxes. All right, that's page 1 of a corporation. Page 2 are those dividend deductions. Some of these get up to, all right, in your textbook, I think those are in chapter 3. I'm not 100% sure, but I'm not going to labor after them all, period. I'm just going to, I don't see it in chapter 3. All right, I don't see that. Maybe I can get back to it later. I thought it's chapter 3. It may be on chapter 2 or 4. All right, but some of these dividends you may get 70% deduction. Okay, moving on, tax computing. Now, if you look at line 1, check if the corporation is a member of, probably not. Line 2, see instructions. Income tax. That's probably your income times 21% tax. We just have to look at those brackets like it's in the book. And by the way, over here too, always be careful with line 12 and 13. If officers are in line 13, you got to take them out. Officer salary, you take those separate, then everything else is salary expense. This is payments. You do estimated payments. These are usually just a bunch of check nodes, but some of them are not. You got to fill them in. Accounting system, cash accrual or hybrid. Business activity. If it's code trucking, you got to find the code. Product or services code, and so on. And then read the rest. In any foreign or domestic corporation, that's probably a no. And then you put, all right, at the end of the tax year, if one owned directly 20% or more, yes or no. And here we put in the name of the corporation, ID number, country, percent owned and voting stock. Okay, we can fill those in pretty easy if we have the information. Now, here's a bunch of yes and no's. Now, this is page 5, bunch of yes and no's. But page 6 is the important page. You got to have a beginning balance sheet and an ending balance sheet. You got to do this M1 schedule, reconciling income on the books with your tax return. Some things you have on the books that's not on tax return. You could have used straight line depreciation on the books, but on tax return you're going to use accelerated. All right, and then M2, retained earnings. Beginning plus net income minus dividends gives you ending. That's just like in accounting. So if you know your accounting, an income statement, a balance sheet, a retained earnings statement, it makes a corporation 1120 pretty easy. All right, one more form. All right, Clayton, we're down at line 2. What does it say that form is? What does it say that form is, Clayton? Was it 1125A? Look at line 2, cost of goods sold. What is it?
Or 1125.
Right. All right. Now, that goes along with this corporate return. So let's look at it real quick. There it is. Now, you've done this before, too. Cost of goods sold. You take beginning inventory plus purchases, gives you a total. Minus ending inventory gives you cost of goods sold. But now we may have cost of labor in here. Like I told you, if I had a used car lot and I had somebody go wash it, detail it, do some work on it, I'd add that labor to the cost of that car. Here you do check your inventory. Are you using cost, lower cost to market, FIFO, LIFO, or what? And check if it was adopted this year and so on. All right. So I want you to get familiar with putting something on that corporate return. And I want us to try a problem where you put it on a corporate return. And chapter 3 is long. We've got a long way to go with it. But I want you to try to put a problem on the corporate return. Now, all I'm going to ask you to do is that example's not good enough. I don't know what. I guess I want you to do problem C3-65. C3-65. Well, they give you a lot of information, but you got a long time to do that. So start working on it. It won't be due for a couple of weeks. If you'll bring your 1120 in, we'll work on some of that problem together, see where it goes. Got to get used to the corporate form. All right. Now, I know I don't have the proper PowerPoints. I am going to go to chapter 3 for a minute. This has not changed. All right. The corporate income tax. All right. We know a corporation can use accountant or fiscal. My son called me from Tennessee. He's opened up a chiropractor office, and I encouraged him to incorporate it so he could be an employee and so on. So he did his corporation in June. So he called me and some other fellow said, well, I've got to turn my corporation fees in March. And I said, son, you haven't been in operation a year. So they probably won't send you a bill until sometime in May or June. So he was going to check on that. I don't know what happened. Tax year must be a financial accounting year. Tax year must always end on the last day of the month. We know we take gross income minus deduction. A special deduction would be that dividend. We get taxable income, then we look at the foreign corporate tax rates. All right, Clayton, can you find in chapter 3 where it mentions the corporate tax rates? See if you can find somewhere in chapter 3 if it mentions the tax rates. It should, but page 5. All right, under corporate tax rates, Prior to the enactment of the Tax Cuts Act of 17, corporations faced a gradual tax ranging from 15 to 35 with two bubble rates at 39. However, prior to 2018, a corporation having more than 335,000, a taxable income would have had a 34% tax rate. Now, the pre-2018 tax rate is reproduced inside the book cover. We know that. But for tax years beginning after 2017, that's 2018, corporations, including personal service corporations, are subject to a flat what? Flat what? Read that, Clay. All right. Always remember a corporation tax rate is a flat 21. Calculate the corporate tax liability. Your regular tax, they have that alternative minimum tax too. This accumulated earnings tax, if a corporation accumulates too much retained earnings, they pay another tax. Okay? That was regular tax. Now I want you to look at sale and exchange of property though. This still applies. Net capital gains equals any net capital gains greater than net capital losses. If there is a net capital loss, then cannot take deduction when. All right. I want you to look at this line, Clayton. Well, I could. What does that say?
Cannot deduct.
If it's a capital loss, you cannot deduct it currently. You have to wait till next year. Now you can carry it back 3 years if you want to. You can carry it forward 5 years. I think you can forego the carry back. We'll have to see. Carry back and carry forward treatment as a short-term capital loss. All right, so we'll have to look at capital losses in this chapter. All right, now I want you to look at page 6. At the bottom of page 6. A corporation has a capital gain or loss if it sells or exchanges a capital asset. As with individuals, a corporation must net all its capital gains and losses to obtain its net. Now, net capital gains, a corporation includes all of its gains, all right, for the tax year in gross income. Unlike with individuals, a corporation's capital gains receives no special tax treatment and are taxed in the same manner as your ordinary income. So if you have a long-term capital gain for a corporation, it's taxed. We pay 15% tax, corporation pays 21%. All right, but now what did it say about a loss? Now over here on page 3-7, if a corporation incurs a capital loss, it cannot deduct the loss in the current year. A corporation's capital losses can offset only capital gains. They never can offset the corporation's ordinary income, never. A corporation must carry back a capital loss as a short-term loss to the 3 previous years. So it can't offset ordinary income. So right here, if there is a net capital loss, it must be carried back 3 years to offset only capital gains. Then it can be carried forward 5 years, all right, until the capital loss expires. It's a short-term loss. All right, so be careful with those 2 pages, capital gains and losses. Now, business expenses, we know about those. Ordinary necessary expenses. Startup expenses we can capitalize and amortize over 180 months. Well, now, Clayton, divide 12 into 180. All right, 15 is what I got written down here. Okay. So you can capitalize or amortize startup expenses over 15 years. Organizational expenditure generally must be capitalized and amortized. Now, I don't know if that's 5 years or 15. All right, now charitable contributions, I want the PowerPoint and the book to go hand in hand on those. And all right, Clayton, help me find charitable contributions. I'm missing that page somewhere. Look in your appendix. It's in this chapter. All right, the only thing I see on charitable donations in your book is page 11. Treatment is different, sure. Timing of the deduction. Corporations may deduct contributions to qualified charity organizations. It must have been paid during the year. We know that. A special rule, however, applies using the accrual method of accounting. Even if you owe it, you can deduct it. All right, and the board of directors authorized a contribution to deduct part of it on accrual basis. All right. Now, to look at my PowerPoint on a charitable donation, now, there is an exception to pledge on accrual basis. I don't know what the 5% rule is on this. This corporation contributes a forklift to the Salvation Army for use in the warehouse. It had an original cost of 10 and 4 of depreciation, so its basis was 6. And been taken, the fair market value of equipment was 9. All right. Are we going to take 6, the basis, or 9, the fair market value? I'm hoping we can take the fair market value of 9. Now, if a retailer donates blankets, that's inventory. That is not capital gain property. It would be the cost of $5 times 1,000 blankets. It would not be retail. Back to capital gain property. Cost of the land was 50. Fair market value 125. What is the charitable donation? All right, we take 10% of adjusted taxable income. Now that's what I want to find in your book. 10% adjustable taxable income. And I have not seen that. I'm sure it's still the law. And we're following along on page 12 of your textbook and 13. All right, I want you to go to the bottom of page 12, 13. Maximum deduction permitted. Limit to 10% of adjusted taxable income. All right, now that's what I've got on the screen here. It all holds true. Now, Clayton, what if your taxable income was $800,000? How much could you give as a charitable donation? How much could you give as a charitable donation?
80,000.
All right, you'd multiply that by 10%, wouldn't you? All right, so if you gave 70, you could take it all, right? If you gave 60, you could take it all, right? But if you gave 90, you could only take how much? 80. Your limit to 80. Now, if you gave 90 and your limit to 80, how much? What can you do with that other 10? What can you do with the other 10,000? Well, the NOL you can carry back. Net operating loss, capital losses you can carry back. Dividend received deduction, take them to currently. Take these current. All right. But how about that charitable donation? What do we carry it to? Again, look at page 13 versus your textbook. Adjusted taxable income is the corporation's taxable income. Now, the charitable deduction, the dividend received deduction, and the capital loss deduction. Contributions that exceed the 10% limit are not deductible in the current year. Instead, they carry forward to the next 5 years. You see that? All right, you get 10% and you carry forward 5 years to try to get 10% next year, 10% next year. All right, you deduct up to 10%, and here it tells you it can be carried forward the next 5 years. And it does expire if you don't use it up. All right, special deductions. Let's first off looked at the dividend received deduction. All right, now Clayton, I want you, since you're the only one here, let's go over to page 15 and go down through there. Limitation on dividends received deduction. Find me any kind of percent that they're using down through there. Now find any kind of percent you can. Now, first off, this U.S. production activity. Let me mention that first. This could be on the individual, a partnership, or a corporation. If you have certain productivity in this country, you get a production activity income, and you get to take 9% times lesser of your activities income or taxable income. So IRS will tell you what production activity income is. You know, domestic production, we know an automobile factory produces, don't they? We know Joy Manufacturer makes mine equipment, so what? You can even carry that net operating loss back 2 years and forward 20. I want to get right up to, I'm not going to look at this code group. What happened to my dividend received deduction? That's my DRD. Okay, Clayton, you found 50% on page 15, right? Now, what's that 50% for?
deduction is limited to the lesser of the dividend received.
What is that deduction for, though?
Dividends received from corporations.
Yeah.
Less than 20%.
How much do we own of them? Less than what? If we own less than 20%, the deduction is limited to the lesser of 50% of your dividends, which is usually the case, or 50% of income. So if you received $2,000 in dividends from a corporation that you own less than 20% in, you receive $2,000. How much do you report? 50% is 1,000. All right, but that's not the rest of the story. Some corporations may be eligible for 65% deduction. It should have said that pretty much at the beginning, but I don't see it. Go back up and look at the top of page 15. General rule for dividend received deduction. Corporations that own less than 20% may deduct 50% of the dividend received, which we just covered. If the shareholder corporation owns 20% or more, but less than 80% of the stock, it may deduct what percent, Clayton? That's the other percent I wanted. So, if we received 100,000 dividends and we own more than 20% of that corporation, we get to exclude 65% of that, don't we? All right, and we're only taxed on 35. Now, what do you think that is? All right, here's A corporation, B corporation, and you, the stockholder. Now, A corporation is owned by B corporation. Now, A corporation gives B corporation a dividend of $100,000. Now, B corporation gives you a dividend. Now, so A corporation is taxed at 21%. They don't get to deduct this. You pay taxes at 21%, or B corporation does, and you may be in a 25% tax bracket. Look how many times that tax money is getting taxed, and that's why if this corporation pays taxes, dividend is not a deduction like interest expense. This corporation pays taxes, B, you pay taxes, that income will be taxed up to 3 times. So corporation B gets to take out a 65% deduction, and that's why. So it won't be taxed up to 3 times. Does that make sense, Clayton?
Yeah.
All right, moving on. Now, I think this used to be, here's the old rates. Those have changed, though, the 20 and 65. When you read this book, DRD is dividends received deduction. All right. And then we get to, I'm not worried about affiliated groups. I want to go down and look at page 18. Page 18 is NOL, isn't it? Now, Clayton, if I had a business this year and they had a $5,000 loss, remember, this is a corporation. And my son can do this too. What can you do with that loss? Take it back where? And forward how many? Now, what else can it do right here, Clayton? What can it do right there? it can forego that carryback, right? And just take it forward, right? Now, I don't want to go back 2 years and do tax returns, so I would just carry forward. That's the way I did my last corporation that had an NOL. All right. Now, we know what an NOL is, and I wanted to see what if the new laws changed anything on the 2 years and the 20. Will be limited in the carry over year to 80% of taxable income, and we limit to 80%. NOLs incurred before 2018 carry over 20 years and are not subject to 80%. All right. So you got an 80% rule. And I don't know the number of years. Clayton, I'm on page 318 under NOL there at the bottom. I'm trying to find if that 2 and 20 are still good. That'll be on those pages somewhere. The 20 years still apply. That's all I've seen.
Yeah.
We're only looking at 20 years, folks. I don't know if the 2 is still or not. But now they're limiting you on any income too. If you read there, they're limiting you on 80% taxable income the next year. So you couldn't take 100%. All right, so what are your deductions first? Take all your NOLs and your dividends received. That's production activity deduction. Then number 2, take away your charitable deductions. Number 3, number 4, number 5. I won't get into this parent and subsidiary. We'll have to look at that stock, brother and sister. You have to look at those relatives. Here's Walt. Here's Gail. Wow. Walt owns 30% of North Corporation. And Gail owns 70% of North Corporation. That's 100%. That would seem to be a controlled group. But here, Walt owns 7% of South, and Gail owns 30. They're a control group. That's all they're called. I hope we don't do any consolidated returns. Compliance issues, you got to make estimated payments 4 times a year, quarterly. Requirements for filing and paying taxes, and tax return schedules. So we need to start looking at some of those forms if you'll bring them to class on Thursday, Clayton. And Clayton, you're going to promise me you'll be here Thursday. All right. I hope these other guys are too. Okay, that's your net operating loss. And control groups, you can read about that. That's why I skipped over it. This brother and sister who own stock. And we looked at tax planning. Compliance is your estimated taxes. Now, so far, what do we have? All right. If my son incorporated, he only pays taxes on his salary. The corporation will have to pay 21%. He won't. They don't give to him in dividends or salary. He don't have to pay taxes on it. The corporation can be sued. He cannot. The corporation can take dividends deductions. He cannot. The corporation can carry back NOLs or forward. He cannot. There's a lot of advantages to incorporating. And I'm glad my son did listen to me on that one item. All right, so Clayton, if you will bring 1120 to class on Thursday, we're going to practice one of those to see where everything goes, okay? Now, I read you about the M1 and the M2. We're going to practice those Thursday so they'll make sense. But look at page 36. I was hoping they'd have a copy of the 1120 up here, but they don't. Huh?
Print 1120 up.
Yeah. All right, look at page 36, bottom of the page. Net income for the year. This is your M1. Federal taxable income is 94. And net income is 361, but your federal income tax. Now your federal income tax is an expense, 94,000. Excess of capital losses over capital gains was 12,000. Prepaid rent is 8,000. Bad debt expense 9,000. Premium on life insurance 2,800. Now we're adding 361. See, we'd already taken out federal income tax on the books. Add back the 12, add back the 8. Add back, I guess, let's see. Hey, have you got a calculator? All right, add 361, 94, and 12. 361, 490, 94, 710, and 12. Now, what does that give you? I'm on page 3-36. I'm down at the bottom of the page. All right, do you see those numbers on that M1? You do? All right, I want you to add 361, 94, 7, and then add 12. What does that give you? Then add that 8 and then add 11, 8. That gives you 488.
You're on page 36.
Huh?
You're on page 36, right?
Page 36. Have you found it yet? It's figure C3-5.
Oh.
Figure C3-5. Okay, are we good? I wish they'd put that up here. All right, you find that, Clayton? All right. Now on the right-hand side, line 7, tax-exempt interest. Well, see, that interest was on the books as income, but we're not going to be taxed on it. Deductions on this return not charged against book income this year. We got $110,000 more in depreciation for tax purposes because we used accelerated than we did on our straight line books. So we will take that 3,000 and that 100 and get 113 and subtract it from 488, and we'll get income 375. That is reconciling your book income with your taxable income. Now on page 37, we got retained earnings, beginning balance 400, net income 350. We got a tax refund of 15, that makes 765. We give out dividends of 250,000, that leaves ending retained earnings at 515,000. We've done those before in intermediate accounts. All right, it's a hard chapter, folks, and I do need you to read it. It's a very important chapter because it's your corporate return, and it's your deductions, and it's your charitable donation, it's your net operating losses, it's your capital gains and losses. There are tons of examples. I wish you would be looking at those. Bring at least one 1120S to class on Thursday. Clayton. And Clayton, you owe me the problems, and so does the other guys on chapter 13, even problems. Now, you've got a corporation return to start. And read chapter 3 real well on corporations, okay? And I'll see you Thursday, Clayton.